Financial derivatives are complex financial instruments whose value is derived from the performance of an underlying asset, index, or interest rate. Here's an overview of the science behind financial derivatives. Types of derivatives. Derivatives can be categorized into several types based on their underlying assets. Forward contracts, an agreement between two parties to buy or sell an asset at a future date and at a predetermined price. Futures contracts, similar to forward contracts but standardized and traded on exchanges, with clearinghouses guaranteeing the performance of the contracts. Options, contracts that give the buyer the right, but not the obligation, to buy, call option, or sell, put option, an asset at a predetermined price within a specified period. Swaps, agreements where two parties exchange cash flows or other financial instruments based on a specific benchmark or interest rate. Purpose and utility. Derivatives serve several purposes in financial markets. Risk management, hedging against price fluctuations in commodities, currencies, interest rates, and stock indices to mitigate financial risks. Speculation, investors and traders use derivatives to profit from anticipated price movements in underlying assets without owning them outright. Enhancing market efficiency, derivatives provide liquidity, price discovery, and facilitate price transparency in markets by allowing investors to express their views on future price movements. Mathematical and statistical models. Derivative pricing and valuation rely on mathematical models, such as the Black-Scholes model for options pricing or the Cox-Ross-Rubinstein model for pricing options in discrete time. Black-Scholes model calculates the theoretical price of European-style options based on variables such as the underlying asset's price, volatility, time to expiration, strike price, and risk-free interest rate. Monte Carlo simulations, used for complex derivatives and scenarios where closed-form solutions aren't feasible, simulating numerous possible outcomes based on random sampling. Risk assessment and management. Managing derivatives involves understanding and mitigating various types of risks. Market risk, potential losses due to adverse movements in underlying asset prices or market conditions. Credit risk, risk of default by the counterparty to a derivative contract. Liquidity risk, difficulty in buying or selling derivatives without significantly affecting their prices. Regulation and oversight. Derivatives markets are subject to regulatory frameworks aimed at enhancing transparency, reducing systemic risks, and protecting investors. Central clearing. Clearinghouses act as intermediaries, guaranteeing the performance of derivative contracts and reducing counterparty risk. Reporting requirements. Mandates for reporting derivative transactions to regulatory authorities for oversight and systemic risk monitoring. Applications and impact. Derivatives play a crucial role in global financial markets, influencing pricing mechanisms, investment strategies, and risk management practices across various asset classes. Corporate finance. Companies use derivatives to manage currency risk, interest rate risk, and commodity price risk in international trade and operations. Investment portfolios. Institutional investors and fund managers incorporate derivatives to enhance portfolio returns, hedge against risks, and diversify investment strategies. Understanding the science behind financial derivatives involves grasping their mathematical foundations, economic principles, regulatory environment, and practical applications in managing financial risks and optimizing investment opportunities in global markets.